Hello, dividend growth stock investors. Happy Sunday to you. It is Colby, the DGI Crab, doing that weekly video where I go over the four tiers and see where the value lies in the stock market for the upcoming week so you can get some ideas, make a plan, and know where you're going to allocate your investment dollars for the upcoming week. If you're new to the channel, I have 60 dividend growth stocks that I stick to, and I have split them into four categories or tiers based on the age and time horizon of the investor, which I believe is the most important metric that a dividend growth stock investor should take into consideration when purchasing their passive income. Right now, you guys, I am all in on Pepsi. Pepsi has been down over the last few weeks. It's certainly been in my buy zone for Pepsi, which not only is it a stock that I love, but it is one of my top 10 favorite dividend growth stocks of all time. Pepsi did a dividend increase recently as well. There is so much to like about Pepsi, but the market is punishing it. So before I even jump into the spreadsheet this week, you guys, I want to just do a quick rundown on Pepsi here on Seeking Alpha on the dividends tab. You can see right now the current day yield on Pepsi, 4.36%. Payout ratio is a little high, 67.5%, but as I said, they just did a dividend increase of about 5%. So I don't think that they are particularly concerned about the safety of that dividend, or we wouldn't have gotten a dividend increase out of them. A little bit lower compared to what they've done over the last 5 years. The growth rate on that dividend is 7.25%, and they've increased that dividend for more than 50 consecutive years, making Pepsi a dividend king. And what I really want to do here, guys, is let's look at the dividend yield tab just so you can get a sense of what that 4.3% yield is and why it is so appealing. If we look back here at the previous 10 years of yield history for Pepsi, you can see the average yield in 2025, it's been 3.69%. But if we look back down here all the way to 2015, do you see any fours here? I don't see any fours. The max yield, and this is obviously going to be updated here in the coming days. Looking down here at the max yield, do you see any fours? I don't either. Pepsi is yielding higher right now than it has yielded since at least 2015, but going back maybe even further than that. Really, really exciting stuff, you guys. And also, if we take a look at their dividend growth history, they did a 7.79% increase last year, and you can see over the past few years, the 5-ish percent increase we're getting out of them this time around is on the low end of what they typically do. But it's not necessarily something that's totally out of the question either. We've gotten some fives, we've gotten some sixes over the years. Sometimes they do a little more like 9 or even a 13. But just looking back at the previous 20, 25 years, you see very consistent increases out of Pepsi. Sometimes some slower years, sometimes some bangers, but it's pretty consistent overall. You know that you're likely going to get at least 5% out of Pepsi year in and year out on that dividend increase, and the yield is well above what it typically is ever at. So that's very, very exciting news. Oh, and just real quick, not a licensed professional. Do your own due diligence. This is not to be taken as investment advice. And my allocation strategy, 50% into ETFs, and I'm looking for single stocks yielding 30% or more above the 4-year average. So that's the strategy, you guys. I'm going to jump right into that spreadsheet. That's what you're all here for. That's what you expect out of the crab. So if we start on tier one, Tier 1 is the 18 to 30-year-old investors. This is for the younger folks out there who don't necessarily need a high starting yield. Typically, you're going to be looking at stuff that's yielding in the 1.5% range a lot of the time in this group of stocks. But what they have individually and certainly cumulatively is a dividend growth rate year over year comfortably above 10%, which is absolutely what you want to be looking for when you are young, especially because you're going to have a lot of years in the market to let those dividends compound and snowball into a ton of passive income. Take some time, it takes some patience, but trust me, you guys, that patience will pay off. Don't chase high yield trash if you are young. don't chase high yield trash regardless, but the younger that you are, focus on that growth rate because that's what it's all about. And you've got three opportunities here in the buy zone. This is the valuation metric where I'm comparing the 4-year average yield to the current day yield. And we can see here that Nike, UNH, and Nordson remain the three stocks that are primarily in the buy zone. Now, for me, if I see a stock that's yielding 50% or more above the 4-year average yield, I throw the age tier thing out the window, and I just think that it's a great buying opportunity for someone of any age. And all three of these stocks are not only in my buy zone, they're in my super buy zone. I got the crab claws out. I'm pinching up these stocks all over the place. This is a wonderful buying opportunity for all three. And I think out of those right now, UNH being way down below $400 a share, you're getting a 2.2% current day yield buying UNH at these super low prices. The 4-year average yield at 1.34%. UNH might actually be my second favorite deal on the entire dividend growth stock market right now, second only to Pepsi. Now, tier two, those 31 to 40-year-old investors who are going to be able to pick up a little higher starting yield, maybe on average about 3%, because we are looking for undervalued stuff. We're going to get a high single-digit year-over-year growth rate with this group of stocks. We've got 4 in the buy zone, same as last week. Target, Hershey, Starbucks, and Next Era Energy, all looking very, very buyable right now. The 4-year average yield that I update every single week. Sometimes it changes just by a basis point or two, sometimes not at all. Target jumped up from 2.56 to 2.58 after another week of being down, but yielding 4.65% is absolutely stunning for Target. I think that dividend is still plenty safe. Target, another dividend king, 50 consecutive years of increasing that dividend. Not worried about the safety of the dividend. The growth rate is probably going to be kind of crummy in the short term, but these are longer term plays, even at 31 to 41. So the idea is you load up on something when it's yielding 4.65%. Maybe it gives you not all that great growth for the first year, maybe 2 years, gosh, maybe even 3 years. I don't know, but you don't want to project too far out. You never know what's going to happen. The idea is you pile that up now, and then when Target gets back to the point where they're doing 10% increases, you've got a nice pile of it where you've started out with a dollar cost average well above, or a yield cost average well above 4%. So I would be taking advantage of these deals in that 31 to 41-year-old category. Hershey's still my favorite of the bunch. You guys know I've been singing the praises of Hershey for a very long time, primarily because I waited a couple of years to even initiate a position into Hershey because it was never undervalued. It's been undervalued now for about 5 or 6 months. So I've had a great time continuing to gradually build up my position in Hershey. That's one of my top 5 largest single stock holdings now is Hershey, and I'm not going to slow down on it because I do think there is a recovery story for Hershey. Don't know when it's going to happen, but so long as that yields up here at 3.2, the 4-year average is down here at 215, looks pretty solid to me. Tier 3, 42 to 53-year-old investors, we are looking for at least starting yield of 3%, but hopefully closer to 4 for a lot of these. Don't want to throw dividend growth out the window. He's still hoping to get about 5-6% year over year dividend growth, but a higher starting yield. You can kind of see how this works, right? As you go up in years, a little bit higher starting yield, a little bit slower growth rate. That's the trade-off, but we're just kind of stacking these stocks. And by the way, I don't sell these stocks. If I get one that's gone way up in value that looks kind of overpriced to me, I just sit and hold it. I have dividend reinvestment turned on across the board. So that way I can continue to gradually grow positions even in the stuff that looks like it may be a bit overpriced. Archer Daniels Midland, the aforementioned Pepsi, Hormel, and GPC, all firmly in the buy zone. T. Rowe Price kind of zips in and out of my buy zone depending on where it is at, but their 4-year average yield just keeps jumping up a couple of basis points every single week because they remain so down. I would be definitely mostly focused on these 4 if I were in this age range. Johnson & Johnson is one of my top 10 favorite dividend growth stocks. If that yields 20% or more above the 4-year average, I personally start buying it. So come Monday, if Johnson & Johnson stays here at about $154 a share, I'm going to add probably just maybe like 15 or 20 bucks to my Johnson & Johnson position. Maybe not a whole lot, but definitely one that I just want to take the opportunity to add a little bit to it here and there when it's trading a bit undervalued, which I believe it is right now. And Chevron getting very, very close to being in my buy zone. Are you guys buying Chevron right now? Because I'm looking at this current day yield right now at 4.94%. I know it hasn't quite hit that 30% off the 4-year average, but man, Chevron's a great stock. Getting it at a 5% yield, I think, is a pretty nice deal. So I certainly wouldn't fault anyone for adding Chevron at these prices. No, sir. And then tier 4, age 54 and older investors, higher yielding stocks, slower growing, stable yield, hopefully 5%, if not better. And then, maybe 2 to 4% year over year dividend increases. Still haven't had anything in the buy zone in this category, you guys. There's only 10 stocks that met my criteria of being high enough yielding to fit this category and also have a nice history of dividend growth. I would say of all of these right now, I'm probably not adding any of them. If I'm in that 54 and older category, I'm going to stick more to income producing ETFs as opposed to risking things on individual single stocks. But I'd just say be patient with this group of 10, you guys. At some point, one of them is going to go down. The last time that I personally added to my Altria position is, let's see, that was about 18 months ago. Maybe it's 2 years ago now. Altria went all the way down into the low 30s and the yield shot all the way up to 10%. And I added to my position at that point in time. And then I haven't touched it for quite a while, but my yield on cost on Altria Group is well above 10%. Just because I was patient and didn't buy it up when it was, yielding 7, 8%, just wasn't quite good enough. There will be an opportunity to buy these stocks at some point in time at a discount. But for now, let's just be patient, all right? So we're going to stick to that half ETF, half single stock strategy. For those tier 4 investors that don't have anything in their personal buy zone, my 50% allocation for the tier 4 investors generally breaks down like this, where I get 15% for SPYD to give me some blue chip high yield stocks. And then I'm going SPHY for high yield bonds, monthly payer. PFFA for preferred shares, monthly payer. Devo, JEPQ, and SPYI covered call options, all monthly payers. And then MLPX, very tax advantaged MLP exposure. All this stuff is high yielding, but I'd be doubling down on all of the above as opposed to reaching on any of those single stocks. And for the tiers 1, 2, and 3, a little bit more simple. It's all very much stock focused. I'm not doing bonds or MLPs or preferred shares or anything like that prior to age 54. I'm doing S&P 500, small cap, dividend appreciation, and international in that tier 1. 25% dividend appreciation in tier 2. S&P 500 and small cap, smaller amounts. SCHD, VYM, DHS in tier 3. Now, the stock allocation for the group, there's a lot of things that you could do here. I would be hitting Pepsi really hard. I think tier 1 could do a 20% allocation into Pepsi this week and then doing 5s into Nike, Nordson, UNH. That's in their own tier, the undervalued ones. And then Target, ADM, they're both 50% or more higher yielding than they typically are. So I could reach up into the older tiers and grab some of those because I think they're a decent growth play now. And then J&J, not a bad idea here. Tier 2, tons of options. I'd still hit Pepsi the hardest, but they've got Target, Hershey, NextEra, Starbucks in their own tier. They've got ADM, Nike, UNH, all looking like good buys in the other tiers. And then, of course, Johnson & Johnson, I'll keep hitting there. Tier 3, Pepsi, ADM, J&J, Hormel, GPC, all within their own tier. And I think reaching down and grabbing some Target with that high 4% yield is a fine idea for that tier 3 category. And then for the tier 4, I do a 5% allocation into Pepsi just because when I'm doing an ETF double down, I don't double down on my international investment. I just keep that at 5%. Got 5 left over. Pepsi across the board, you guys. I'm very much all in on that right now in the low 130s. And if it falls farther, I'm going to be even more all in on it. Stay down there for another week or two, Pepsi. I want to be able to build that position up a little bit more. What are you guys buying? Let me know in the comments. Email me your questions at dgicrab@yahoo.com, and I will see you on the next one.